Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, March 23, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And what we had today was not much of anything really. The market was a little bit of back and forth nature. It was up earlier in the day and we took a dip lower, presumably on the announcement that the healthcare bill vote will be, or repeal vote, I guess, will be delayed at minimum of till tomorrow. So apparently that's the excuse for the markets going down. I have my other ideas about that. But nevertheless, the market is showing signs of increased volatility, number one, which is good. It's good for trading. It's good for activity rather than the sleepy markets. But that's not really what's most important. What's most important is what's developing across the different markets we look at in terms of the look of the pattern. And what you see here is the beginning. It's not fully baked, obviously, yet. It's only 2 days old, but we seem to be making a bearish consolidation pattern. So I think there's a couple of things that we need to discuss on that because it's important to understand what the likelihood of various market moves are over the next several days. So what you have is a potential bearish pattern developing. So we could have another, 1, 2, maybe 3 days like this before a breakdown, if a breakdown's going to occur. Now, that means that the market's going to want to get higher than it is now. It's going to want to go back and forth, making this bearish consolidation pattern, and it's going to want to go higher than the highs today, and it's also going to want to come down at some point in time to kind of fill out the pattern, if you will. So ultimately, we could have a candle that goes all the way down like this. We could have one that goes up like this. And under normal conditions, they'll actually want to get as high as or close to the high of the red breakdown candle, which is 237.61. You also have the 20-period moving average sloping in, so that could contain the market up at that higher end. But think about it in terms of what would be happening if the market was going higher, reaching for the high of this red candle. Now, I don't know that we get to the high of the red candle. That seems unlikely if this bearish pattern is going to develop. However, if we get higher than we were today by any significant amount, for example, where we are now is basically 234. So the high of the candle is 237.61. Even if we got to 236, that's 20 S&P handles. You're going to have bullish sentiment on the way up. Everybody's going to think the worst is over. They're going to continue to say, buy the market, it's undervalued. This was the one-day sell-off. It's, all straight up from here. You just have to think in terms of how it feels when you start to listen to the nonsense, if you do listen to the nonsense at all. The nonsense brings the bearish pattern towards the top of the breakdown candle, and then that's at the point and when they generally will pull the rug out and you'll see another leg lower in the market. All we're doing now is a couple of things. We're working off a short-term oversold condition. And where does that oversold condition come from? Well, it comes from just a few days ago. We were all the way up in this range here at a high of 239.20. From the high to the low was about 50 S&P handles, 50 S&P points, 5 SPDR points. In 4 days, that creates a short-term oversold condition that needs to be reset. And that's what bearish patterns are made out of. The market basically hits a level, and now it wants to reset and build energy for another move lower. Now, what may or may not happen, we don't know yet, is that next move lower, if we're going to have one, may only go to the 50-period moving average. It may only go to 232. Well, there's no telling exactly what's going to happen. I have the market going down to this level down here at 228. Whether or not we get all the way down there remains to be seen. But the reason I put these numbers on the chart is not as much as it is a target, meaning we have to get there, as much as it is, and by the way, I think we have a good chance of getting there, but it's not so much for the target of where I think we must get to, but it's more so if we did get there, it should create a really, really good buying opportunity. But we have to think of it in terms like this. Time is more important than price. The type of corrective pattern that I'm looking for, or corrective move, I should say, that I'm looking for is generally good for in the neighborhood of 3 to 5 weeks of market activity. And that's typically enough time to work off the overbought condition. Well, we really started this corrective phase back on March 1st or March 2nd, right? So if you think about it, we're about a month in and we're coming into that time zone where we're going to start looking for another turn for the next leg higher in the market. I'm not saying it's tomorrow and I'm not saying it's next Monday. What I am saying is next week or potentially the week after, I am going to be looking for a low. Whether or not that low comes in at 228, we don't know yet, but I'm going to start looking for a low based on time more than price, and it's coming up pretty soon. Remember, just as a recap, we had the pattern that went from the high, whoops, that's not the tool I wanted. We went from the high down to a low into the 20-period moving average. That was the A leg. Here's the B leg, and then now we're in a C leg. Now the C leg, we may still do this, and I'll end up calling this the C leg. Wherever we end, the C leg is going to end wherever the market ends. Whether or not we put in a bearish pattern for 3 or 4 days from here or not doesn't really impact the fact that I'm still going to call this the C leg wherever it ends. As far as I'm concerned, the ABC pattern is complete, technically speaking. It completed once we got below this low of the A leg. However, we don't know exactly where the final low is going to be, and I don't mean to be confusing, but I just want to give you my thought process. Net, I'm not focused on the ABC anymore. That's done in my mind. Now I'm focused on time and looking for where the market is going to find a low and make a turn for another leg higher. As it stands now, and in my opinion, it has a good chance of happening next week, but it's a little premature, but that's what I'm thinking at this point. All right, let's move on to the IWM. The IWM pretty much looks the same as the spider. The IWM was up a little bit today, and the spider was basically flat to down a little bit, down 0.2% on the spider. The IWM was up almost 0.5%. So there is a divergence there, but I'm not really paying too much attention to the divergence as much as I am right now on the pattern it's making, and the pattern it's making is the same as the spider, which is going to be the same as you're going to see in the transports, which is going to be the same as you're going to see in the NASDAQ. So when I start looking at these things and all the patterns in all the markets look the same, you have to think when 2 or 3 or 4 guys tell you you're drunk, go find a chair. When all the markets look the same, it's generally telling us something. It's generally telling us if they're all putting in the same kind of a pattern, it's likely they're going to finish the pattern. That's at least from my experience. And by the way, if this was going to fail, meaning if this was all they were going to do on the downside, and we started the other leg higher yesterday, for example, where we're wrong is a close above 138.60 in the IWM. It's a like scenario for the spider. Let's just go back there to make sure that we're clear. If we close the day, and I think I mentioned this yesterday, if we close the day above, I don't need that number, I already have it, 237.61, that basically is the signal that the down move is over in my book. All right, let's go back to the IWM. We're really done with the IWM anyway. It's the same pattern as a spider. We don't need to really discuss anything further other than we're holding these lows that I said was going to be important from the get-go, but the only way they're going to break these lows is with a bearish pattern, building energy for another move lower. So that could be what we're doing. That's what I'm looking at. And let's go over to the transports, and the transports are now going sideways. Same routine, same pattern. 3 guys tell you you're drunk, find a chair. And with the transports, the more we go sideways above this 88.30 level, that should be an important level, the less likely that level is going to hold. What does concern me it's not concern me, but what I am looking at on the downside of the transports, if we were to break the 88.30 level, is a real wide vacuum here down to the 200 period moving average and the 8400 level. That's another important figure. So we'll see what happens. Next week, I think, will be a pivotal week. And you have to laugh a little bit about how the trouble in the market is now assigned to the healthcare bill vote. I find it amusing because we really started the corrective phase on March 2nd, and now they're first tying it to the healthcare bill. Nothing's changed, or healthcare vote. Nothing's changed. Nothing changed from last week to this week. They need a reason why the market's going down. This was the convenient reason. It's more like kabuki theater than anything else as far as I'm concerned. Let's take a look at the picture on the NASDAQ. And the NASDAQ is the same routine. Today, again, we tested the 20-period moving average, making the same bearish pattern. I'm not going to harp on that. All I'm going to tell you is find a chair, and we'll move on to the next market, which is, I think we've exhausted the stock markets. Let's go over to the gold market, which had a little bit of a down day today. So the question now is, do we put in a sideways pattern building energy for another move higher, or do we have a more meaningful pullback? We'll know more in the next day or so, but if I had to kind of make a vote, I think the market is more prone to a pullback than just a sideways, for example, bull flag pattern that would just go sideways in this upper range and then would have another leg higher right into the 200 period moving average and beyond. I think we're going to have somewhat of a pullback. Today was day 10 since the low. We talked about that last night. It's no wonder that we at least had some kind of a little pullback, if for nothing else. 10 is always an important number. You can expect some kind of a market reaction or turn on the 10th candle or 10th trading day from an important level, whether it's a low or a high. Look here. Here was a low. Here was your 10th day, the red candle. The next one, here was a low, and I believe this was, let me check it out. Oh, this was the 10th day, a red candle. So you typically will get your moves on the 10th day. The question is, does the move continue, or is it just a one-day move? I think we need more of a pullback in gold. And let me show you another reason why I say this. And this isn't really the reason, it's just something that caught my eye. So here is GDX, and GDX is obviously stalled out at the 50-period moving average, and it looks to be making a bullish pattern, and this could be, and it could be setting up for another move higher. But when you look at the longer-term picture, what I see here is a down move, and we're making a bearish pattern inside that down move. The only way out of this, and normally this would be an ABC pattern, right? A, B, C. That's generally what I would say. But this isn't going to play out until and unless we can close above 2458, which is also the 50-week moving average. So it's an important number. So it's not that I'm saying it won't go higher. I'm just saying that that red candle can and most likely will contain the GDX market. I don't think it's going to get through there so easily. We'll see, one day at a time. Looking over at the silver market, we don't want the weekly market, we want the daily chart. And we're again stuck at the convergence of the 20 and the 50 period moving average, 20 being red, 50 being blue. We're stuck right in there. Made a little bit of a high today, backed off of it. That could be, it's not a great doji candle, but it could be the signal of a trend change. I'm not going to hang my hat on that. I'm just saying it could be. Could be certainly isn't a technical term we ever want to hang our hat on. Now this is a little bit different than gold in that our low was this candle here, rather than this day here that represented the low in gold. And here, today was the 7th candle. So that's also obviously a meaningful candle, 7 and 10, both. So we'll see if we get a pullback in silver tomorrow. Let's go over to crude oil. And crude oil had the retrace that we discussed last night, and we retraced to, let's see, down to a low of 47.58. I said 47.60 in that neighborhood, 60, 50, 65. So that's right in the ballpark of where the retracement would be expected to come to. You know, I'm not suggesting anybody trades this right here, right now. But if you were going to, this is where you would take your shot down at the retracement and you would trade it against yesterday's low on close. It's not a trade I'm taking. I won't be in there with you. However, if you're going to take a trade, that's how you do it with minimum risk. The low is 47.01. You would move out on close below 47.01. You could trade this for a bounce. You should get a bounce from here. However, under normal conditions, however, I still think there's lower prices coming over the, it could be the near term or longer term either way. And when I say longer term, I don't mean months. I just mean into next week or beyond. I think we will get down to that $45 level. That's where I'll begin looking for a turn in the crude oil market and the energy complex. So there's no new information in crude. It's just we got the expected retracement today. That's normal garden variety market behavior. Looking over at the bond market, the 30-year bond put in a little bit of a pause day, a little bit of a pullback, and this was after the 7 days up, 1, 2, 3, 4, 5, 6, 7. Today's the pause day following 7 days worth of upward momentum, -1 in the middle there, but it's still 7 days from low to high, and you're generally going to get a change in direction or at least a pause and consolidation after 7 days or even after 10 days. But it happened after 7. We got a pause. Let's see what happens, whether or not we get any kind of a meaningful pullback or we just get consolidation. One way or the other, it'll give us the next clue for the next likely scenario or next likely move for the bond market. If I had a vote, I would say that we're going to have a normal retracement, maybe a 382 or even 50% retracement, down to the 20-period moving average, for example, 149, maybe pierce through it a little bit down to that day's low, which comes in at the low was 148.16, and that would potentially be an area that the market would find support and take off for the next leg higher in bonds. If we're going to have the next leg higher, which I believe we will have, up to the 159, 160 area. Nothing's changed in my outlook for the bond market. Bond prices go higher, yields go lower. When yields go lower, that's generally the bond market's way of telling us that there's trouble ahead for the stock market. The bond participants are always smarter than the stock market participants, just about 100% of the time. That's why I like to take my cues off the bond market, among other things, among our leading indicators like the IWM and others, but certainly the bond market. If the bond market is giving some kind of a signal, I'm taking that signal to heart. And the last market we'll cover tonight is the US dollar, and the dollar didn't really do anything today. We're putting in a little bit of a pause day like yesterday. We could go sideways for a few days. We could work off some of the oversold or short-term oversold condition. But any way you look at it, my expectation is that the dollar will get to at minimum of 98, most likely down to 97, maybe even to 96, 97. That's the number I've got from a mathematical perspective. My expectation is for lower prices in the dollar. But following that, I expect another rally in the dollar. And with that, folks, I'm going to leave it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.